Good morning, everyone. This is Eric Walters, Managing Partner at Summit Hill Wealth Management. Thank you for joining us for our webinar on keeping a cool head in volatile markets. If you've been paying attention, markets have been volatile lately, and we thought it'd be helpful to take a step back and take a look at what's driving that volatility, how to understand the discussion around inflation, interest rates, and the economy, and then to wrap it up and think about what actions investors can take now to address this volatility and take a historical look at how markets have handled periods like this in the past. So while we're chatting, please feel free to use the Q&A button. You should see something lower on your control panel, and feel free to share a question. We love the interactive questions. We'll answer them kind of as we go. As I mentioned, our discussion agenda will be on how the unprecedented government stimulus, along with a couple of other factors, have likely contributed to the high inflation we're experiencing right now. We'll discuss interest rates, why they matter. Why is it that so many news articles and analyses focus on interest rates right now? We'll go over the volatility and just kind of see how markets have been behaving lately. I'll share 4 scenarios that I see are potential for not only inflation, interest rates, but also the economy, what that means for portfolios. As I mentioned, we'll talk about historical perspective and then also what investors can do. If you're not familiar with Summit Hill Wealth Management, we are a boutique wealth management firm. Our mission is to help families protect and grow their wealth. And that's through good times and bad times. We do that through financial planning. We like to create a holistic, comprehensive financial plan that addresses all areas of a family's finances, that leads to a plan for investing. We really like coordinating with a family's other advisors, and really we can consider kind of protection a hallmark of our approach, and then helping kind of coordinate and prepare heirs. So if you're not familiar with us, if you do have any questions, you can reach us at info@summithillwealth.com. Also, I frequently get questions about slides. People often say, hey, can I see a copy of that presentation? If you'd like, if you have my email, it's ewalters@summithillwealth.com, or feel free to email info@summithillwealth.com. We are happy to share our slides. I want to take a step back, and before we get into the market volatility and just kind of look at it, let's take a step back. And for those of us that joined us in our March webinar, this slide may look familiar. This is just a kind of an approximation about where we think major developed economies are in their economic cycle. You can see there's this kind of half circle here that outlines what happens in general to economies when they are going through kind of stages of growth and then contraction. Early on, you can see some of the descriptions here. Usually demand is quite high. People are feeling pretty good. And then you get to this middle period where demand usually starts to plateau. Profits often kind of plateau and may go negative. And then you can see this late period where growth is kind of continuing to moderate, and usually credit tightens. And that means usually interest rates go up, and also banks are usually more hesitant to lend. And then you can see the policy is contractionary. And you can see where the US, we approximate the US here is kind of past the midpoint here. I think what's important to pay attention to is that there are a number of positive things that are happening in the economy. We'll kind of enumerate them in just a second. But we're getting towards this late stage in a few regards. One is that this contractionary policy has started. The Federal Reserve raised interest rates in March. They raised interest rates again by 0.5 percentage point this week. And they've also announced that they will start to sell assets that they purchased during the COVID pandemic to try to support markets. They're going to start selling those. And so that has an effect of lowering the price of those securities. It's mostly, bonds and mortgage bonds, for example. And when you put a lot of supply in the market, generally it'll lower the price. So not only are they raising interest rates, which is contractionary, but they'll be selling assets. And then you can see this final phase, which is recession. And as you'll see in our discussion today, that factors, to a large degree for investors trying to figure out what's happening right now. And I think what a lot of investors are trying to figure out is If the Federal Reserve raises interest rates very aggressively, historically, that's led to a recession within some period of time. Maybe it's a year, maybe it's 2 years, occasionally it's been 3 years. But I think that kind of explains a lot of the volatility we'll see. But nonetheless, from an economic standpoint, things are actually pretty good. And we'll go over kind of what these are. Again, we enumerated these in our prior webinar. You can see the strengths here. I won't go over them, but there are a lot of good indicators of kind of what's happening in the economy. There's great demand. Consumer and corporate balance sheets are excellent. Unemployment is extremely low. So that's all good news. And I think when we deal with market volatility, I think sometimes we can get tunnel vision and just kind of say, if the market's down, things must be terrible kind of across the board. This is one of those periods where actually the economy is actually doing quite well, but the market is reacting to other things, and they're not the same place. Sometimes the economy and the stock market will move together. Sometimes they will not. And conversely, sometimes the economy is doing poorly and the stock market's roaring. We had this happen in the fall of 2020. If you remember, COVID pandemic was raging. There was a huge amount of infections, and the stock market was setting new records kind of every day. And what was happening is the stock markets usually look 9 to kind of 18 months forward. And so you may be experiencing good or bad things in the economy right now, but the market's kind of looking forward. And I've highlighted these two challenges here that I think the market is really keen in on. The market's very, very focused on inflation because of what that does to consumer spending, what that does to kind of the ability for corporates to maintain their profit margins, and then also what inflation means for rising interest rates. And so I'll go into that, but this is one of those areas where the market is kind of looking forward, and we can look at the positive data in the economy and kind of say, hey, stock and bond market, why are you so bent out of shape? And I think the stock and bond market would say, we're trying to look ahead. Now, the markets are not perfect. It's not as if the stock market has, kind of future knowledge. This is a group of millions and millions of investors around the world that are trying to figure it out together. But I think it's what they're keen in on. Now, when we think about kind of how did we get to this position, I think we have to start with the fact that we are recovering still from the COVID pandemic. And I put up a graphic here that's from McKinsey that just shows what was the scale of kind of bailout money from the 2008 financial crisis, which was the worst financial crisis that we have experienced since the Great Depression. And you can see those kind of blue circles there, and for most major developed countries here. And it was certainly a large amount of money. I don't want to diminish that. However, when you compare that to the amount of stimulus after and during COVID, it's mind-boggling in terms of the scale. Germany 10 times the amount of stimulus after COVID than 2008, and the United States considerably more. I won't go through all the numbers, but there's a massive amount of stimulus either through direct spending or tax offsets that have happened. And so when you think about all this money in the system after 2008, many economists said, this much money in the system will lead to inflation. And it's a real mystery of inflation as to economics, why it didn't. After 2008, in 2010, 11, 12, I can't tell you the number of articles that I read that said hyperinflation's on the way. It didn't show up. Inflation was incredibly modest. The Fed struggled to kind of get inflation to go. And, I won't go into kind of the economic textbooks and the theories about why. Suffice to say, after COVID, we have experienced significant inflation. And now that may be because of the scale of the stimulus was so much more. Clearly that shows it. It may be because people were at home in kind of forced quarantine, but most people were still earning money. And maybe a supply chain. And then of course we have the war in Ukraine. All those things kind of come into it. But nonetheless, whatever your political persuasion, the amount of stimulus that's put into the system is literally unprecedented. When you combine that with the fact that the Federal Reserve significantly increased its balance sheet, and so we have basically the U.S. Treasury kind of sending money out. You may remember the PPP program, the enhanced unemployment benefits, there were EIDL loans, I won't go through all of it, but this was huge amounts of money being sent as directly as possible to people. Then you get the Federal Reserve that is using its, printing press to basically print money and just buy assets. It's buying bonds, buying corporate bonds, even buying junk bonds, buying mortgage bonds. What happens? The value of those assets rallies, and the Federal Reserve kind of averts, kind of potential major market crisis. Now, what we're experiencing now is with very high inflation, the Federal Reserve's normal playbook is to say, we're going to raise interest rates and kind of choke off credit. We're going to make things more expensive for individuals and companies, for all the people on Wall Street that run their formulas. We're going to make kind of the value of those future cash flows as I calculate them, we're going to make them more expensive as we raise interest rates. The problem is the Federal Reserve is likely very aware that our federal debt has gone up significantly. And the chart here shows the federal debt as a percentage of GDP. This is a very large number. I won't get into the kind of political view of it if you think this is a good idea or a bad idea, but this is the highest numbers we've seen since World War II. And the Federal Reserve, if they raise rates significantly, meaning, kind of take short-term rates to 5%, 6, 7%, which could theoretically be needed to tame inflation, what will happen is that the US government will have to pay significantly more in interest payments. Now, I've talked to a number of clients about this, and they've said, wow, we're really concerned about that. I am as well. And the Federal Reserve may kind of look at that kind of amount of debt and that payment and say, well, maybe we won't raise rates as aggressively we might have because we know what'll happen to the US budget. So keep that in mind. We're going to talk about kind of the 4 scenarios, but I wonder if, as the Federal Reserve not only reduces its assets, that's going to reduce the value of those bonds. We're seeing that already. But as they think about how high to raise interest rates, are they going to think about the federal debt and what that means for the US government interest payments? It's very possible. So that may constrain them in terms of how aggressive they may want to be, and that may lead to some kind of unintended consequences. So we've talked about inflation, kind of what are the numbers. If you've been reading the headlines, you've probably known that since October, we've been getting higher than normal inflation readings. And this is just a chart that shows where CPI is, on the right-hand side here. And you can see, it's pretty high. It's really a 40-year high. And we've been consistently getting numbers kind of in the 7%, 8% now for most of 2022. Now, I did include a chart that shows sticky CPI, excluding food and energy. And this is interesting. Sticky CPI is defined as a price measurement of things that prices change infrequently. And the reason why this matters is that sticky CPI is something that a lot of Fed governors pay attention to, because if those kind of things are starting to increase, then it may kind of indicate that inflation will be around for a while because those prices don't change very much. So the example of kind of sticky CPI is like auto repair, the cost of kind of electrical repair and kind of home repairs, rent. Kind of large ticket items. Those things don't tend to change as much because it's kind of a hassle for the companies to change them. And they don't want to be seen as expensive. They kind of want to be viewed as affordable. So for example, your local mechanic, they might have to go and actually change their sign, up there, and they might have to recode their software. So it's kind of a pain. So for many times, they'll just kind of say, oh, we're just going to get through it. But as we can see, sticky CPI is starting to increase, and it's kind of in a higher level than we've seen for a while. And now it's not the first time sticky CPI has gone higher. You can see that even in the 90s, it was high, and it did come down. So it's not as if this is Armageddon, but it's just another insight into CPI and inflation, that it does seem to be possibly more persistent. And the reason why this matters is that if companies and individuals are kind of expecting that things are going to get more expensive, if we just stick around, things are going to get more expensive. What that does is it creates a self-reinforcing cycle. And we've seen this in other economic cycles, most notably in the 70s for the US, that if you think things are more expensive, you're going to try to stock up now and then try to stop spending, right? So if you think clothes are going to get more expensive, you might go shopping now and say, I don't want to shop again for a year, or food or whatever. And that's really hard for companies to handle, because what happens is they sell out of inventory and then demand drops. And then companies will kind of say, oh, I don't know, what are we going to do here? And how do we stimulate demand? And then they'll raise prices to maintain their margins. And then there'll be another round of buying and hoarding, and then kind of drop off demand. And that's what the federal governors are worried about, is this kind of idea of entrenched inflation expectations. They want to try to get ahead of that. And that's why they're talking aggressively about raising interest rates. Now, clearly, if we're going to Monday morning quarterback, the Federal Reserve, kind of messed up. When they were being extraordinarily accommodative in 2020, right? They were buying, all these assets. They were talking about how they can keep interest rates low. The market responded in a really big way and went up quite a lot at the end of 2020. 2021 was a banner year for, most assets. I mean, a lot of stocks were up 25 to 40%. And the Federal Reserve kept their commentary very accommodating. It's called dovish. All throughout 2021, they basically said, don't worry, even though we expect some inflation, we think it's going to be transitory. We're going to keep interest rates low. And in hindsight, what they should have done when we got the first indications that inflation was really taking hold in October and November of 2021, they should have started raising interest rates right away. They should have said, you know what, the economy is great, people are great, businesses are doing well, we have to start raising interest rates. Instead, they said, well, we think this is only going to last for a month or two, and we're not going to raise rates. They were saying that up until December and even into January. And now they're kind of in a, whoops, we're way behind the curve. And now they're a little bit like the indulgent parent who has been giving kind of sugary snacks and treats to kids all, for 20 years. And all of a sudden that indulgent parent turns around and says, you're a spoiled brat, you need to go get a job. Everything's terrible. I'm cutting you off. The Federal Reserve is kind of taking that tone right now, and the market is reacting kind of with a tantrum, just like that kid would. So we'll look at that, but that's kind of what the market is doing. Sorry, just let me get back to my presentation here. So, sorry, just gonna pause. The presentation pulled up the link in my presentation here. So let's talk about the dynamic of why the Federal Reserve raises interest rates. This is, key to the whole discussion. There are, economists and, really, really smart investment strategists. They'll basically say the one metric you should always pay attention to is interest rates. They'll tell you everything you need to know. So in general, if, the Federal Reserve feels that things are getting, there's a slowdown in the economy, there's a need for stimulus, they will cut interest rates. This is this red arrow here. And what that does is it makes things more affordable. You can imagine loans for individual, loans for companies. Banks usually will, kind of free up their own lending. But when they feel like things are getting too hot with inflation, there's too many dollars chasing services and goods, if you remember kind of economics 101, they will start to raise interest rates and try to clamp down the number of dollars. Interest rates, it's imperfect, but the analogy that it's the cost of money, it's not exactly always true, but it's not a bad way to think about it. So if you raise kind of the cost of money, you're going to kind of take some of this enthusiasm out of the market. So this is kind of what they're doing right now. They're raising interest rates, generally leads to lower economic growth because purchases and activity kind of slow down. And then the goal is slower inflation. That's the goal. Now, people will say, right, rising interest rates, kind of crash the stock market. That's true, but it's a little more nuanced than that. Usually what happens is as the Federal Reserve begins to raise interest rates, the stock market kind of, does fine for those first anywhere between 3 and 5 interest rate increases, depending on how quickly they occur and how the size of the interest rate increase. So historically, usually the Federal Reserve is saying the economy is good. If anything, it's overheating. Inflation is a sign that there's a lot of demand. We'll start to slow it down. And you can see the table here I put out, as the Fed has raised rates, the stock market has generally moved higher. And this data goes back to the 50s. So we're not, cherry picking a couple spots here. Now, there have been periods, notably in the 70s, where that hasn't been the case. But in general, early on in an interest rate cycle, usually the stock market does well. So it's kind of interesting the stock market's reacting more negatively right now. It doesn't necessarily mean that it will always react negatively or that we're just on a straight line down. But it does mean the stock market is kind of paying attention and not necessarily viewing the interest rate increases as kind of favorable. So we'll talk about kind of why that is. Here's a chart that shows the federal funds effective rate. This is, if you think about the rate that the Fed controls, it's a very short-term overnight rate. So if you look at how this rate has fluctuated in the past, you may remember in the 70s, there was kind of runaway inflation with low growth. They called it stagflation. And Paul Volcker came in as the Federal Reserve chairman and raised this rate very, very, very high. And basically said, we have to shock the system. And in general, this is where the theory comes out that if the Federal Reserve wants to control inflation, it needs to raise short-term rates kind of in the ballpark, if not above current inflation. So remember what I said about how if the Federal Reserve wants to raise rates, it may think about the US federal debt, because right now, if inflation is running at 7 to 8%, does the Federal Reserve have to get short rates to 7 or 8%? Oh boy, that would be quite a change for the US government in terms of how much interest it has to pay. It also would be a huge shock to the US economy, consumers and corporations, because you can see how this rate has been quite low, for quite some time, and it hasn't been kind of up in the fives since the 90s. And so many people who are living their careers, investing, running corporations, if they're like 45, they were like in high school or junior high, but last time, rates were this high. So they're kind of thinking money's always cheap, inflation's always moderate. So they're completely, kind of unfamiliar with this dynamic. Now, if you talk to people who've been in the markets for quite a while, they say, hey, I remember the 70s and 80s, and don't turn your back on inflation, watch out for interest rates. That's, I think, one reason why the market is reacting so strongly. It's not the idea that raising rates is somehow unusually bad. It's that rates right now are so low that the idea, if the Federal Reserve will have to go to basically kind of zero rates up to 7%, it would be a complete shock to the system. Whereas if you were in the 80s or 90s and the overnight rates were more like 6 or 7 and you had to go up to 10, that's more normal in your recent experience and your business and your mortgage and your adjustable HELOC and your line of credit. So all those things, back in the 80s and 90s, you say, well, yeah, a mortgage at 12 or 15%. Yeah, it's high, but that's the way it is. Now people are used to mortgages at 2.875, and all of a sudden they have to deal with a mortgage at 5.5. It's a shock to the system. And I think that's why markets reacting so strongly. So the other thing this chart shows you is that as this federal funds rate starts to trend up, generally a recession occurs. The recessions are highlighted in these gray bars. And how much of an interest rate increase causes a recession, it's hard to know. And people have noted that as time has gone on over the last 40 years, interest rates have not had to go up as much until there's a recession. So you can see kind of in the late 80s, interest rates were more 10, and then there was a recession in the kind of the 90s, they were kind of in the high fives, and then kind of the 2010, it was 5. And then here, it's unlikely the Federal Reserve interest rate had anything to do with COVID, but there's a real question out there that recession could happen at maybe a 3% federal funds rate. And so that has kind of long-term implications, but this is, I think, what the market's really kind of struggling with. Now, as in our webinar in March, we talked about how the yield curve, which is the kind of difference in yields as you go up maturities from, short kind of a couple month maturity to 2 years, 10, 30. The difference in those yields can tell you a lot about economic conditions. And when there's a big difference between short-term rates and long-term rates, it's called steep. And that's when you see when there's a big difference here between, shorter term and long term. A steep yield curve is generally very positive for economic conditions. It shows there's a lot of demand for longer term, funds, and investors feel very comfortable with short-term rates. However, when that difference is low or negative, it usually shows that economic conditions are getting more contractionary. And you can see here that in general, if there's been an inversion, meaning short rates come up and even long rates go down, if there's an inversion, it's actually predicted every single one of the last recessions, including the COVID crash in 2020. Now, it's unlikely the market was anticipating COVID. It's more likely that it was concerned about basically trade relations with China. But nonetheless, you can kind of see when this goes negative, when there's short-term rates are at or kind of higher than long-term rates, usually it means a recession's on the way. The yield curve did invert for one day in April. You can barely see it in this chart here. It just kind of bounced off. The same thing in 2019, inverted for one day. So that just means that market participants are concerned. Now, the lead time is usually about 16 to 18 months for a recession. So it's not as if it happens right away, but nonetheless, the yield curve is kind of confirming that the market is concerned about this. So here's kind of 4 ways I think you could kind of game theory this out, right? When we think about inflation is a big deal because of how the Fed responds with interest rates. We can kind of skip inflation and say, okay, what about interest rates? What could happen here? So, and I've kind of color coded these in terms of how, I think serious they would be for investors. The first one would be a soft landing. And I think a lot of people look at that and are like, There's no way a soft landing is going to happen. But actually, soft landings have happened in the past. The Fed actually has done this, as people bag on the Fed all the time. It actually did it, for example, in the 90s. So the soft landing scenario is that inflation moderates, and there's I think an argument to be made that as supply chains kind of get unsnarled, one could hope that the war in Ukraine will end. I mean, at least from a humanitarian standpoint, that suffering could end. If it did, from an economic standpoint, inflation would moderate. And then also people in their own self-interest will kind of preserve their own cash by buying different things, right? They're not going to go to the $100 restaurant. They'll go to the $50 restaurant. They may, travel to Mexico instead of Fiji. So people will also kind of make their own adjustments, and that has an impact on companies' ability to raise prices. So it's possible that inflation could moderate. The Fed could raise rates more slowly in a more measured way. And historically, that is the kind of Goldilocks scenario for stocks. And many of those scenarios I said in the past with that table where stocks did pretty well for multiple years of rate increases, that would be it. That would be kind of slow, easy rates. Now, I know when I'm talking to clients, many of them kind of look at that and they're like, I don't think so. I think it's going to be really, really negative. That's a possibility. But I also think because we don't know the future, we shouldn't discount the idea that things could actually turn out okay. Right? Just like, for example, COVID, I talked to many people in 2020, 2021. They were like, this is going to be terrible. It's going to crash the global economy and we're never getting back to normal. Well, thankfully, that viewpoint wasn't right. And when we think about inflation, interest rates, we can realize there's a possibility that this could work out actually quite well. The kind of second scenario is we do go into recession. If the Federal Reserve has to, basically say, boy, I'm the big boy now. I'm the real authoritarian parent. I'm going to smack inflation, and they start raising interest rates 0.5% or percent, more aggressively, then it's likely the economy to enter recession, and it may be sooner. Yeah, and it's hard to know exactly when. It's a kind of open question in economics. How quickly does interest rates, higher interest rates affect economy? But then you'd have a recession. And in general, in a recession, people lose their jobs, people pull back on spending, and it kind of takes care of inflation. And a note for all the business owners out there that have been kind of bemoaning these higher wages. If you have employees that are kind of walking into your office like, I should get 20% more. Well, that kind of behavior goes away when unemployment starts to rear its ugly head. So yes, it would be negative for stocks, bonds, and real estate, but it kind of fits a pattern that we're, as investors used to. Interest rates go up, the market prices go down. Usually in a recession, prices often are kind of -20, -25, something like that. And it kind of clears out excesses. It kind of clears out, kind of demand. And then, usually the Fed will lower interest rates and you kind of climb back up. So that's actually not a huge, terrible scenario, because it's kind of, if it can deal with inflation, it's kind of like, if you have a broken bone and the doctor has to re-break it, it's kind of like, ouch, put on a cast and you're all right. Now, the third scenario, prolonged higher inflation, is if the Federal Reserve raises rates, but either by choice or by accident does not raise them enough. And so this is like, for example, the Fed raises rates to maybe 3%, and then says, oh, we think we're going to stop, maybe because they're concerned about the impact of the US debt and interest payments. Maybe they're just trying to be accommodative. Maybe they hope it'll work out. This is kind of a scenario where they take some action, but not a lot. And inflation then maybe moderates, but not enough. So maybe inflation goes from 8 to like 5 or 6%. That's still high enough that it'll in fact impact spending. Then you'll like to see a lot of volatility. The market will kind of say, oh, great, now inflation is going to be around for quite a while. And the market's going to reprice stocks, bonds, and real estate in a more aggressive way. They're going to say, okay, bonds, we need significantly higher yields to justify our rates. So they're going to sell off bonds. And then with stocks, they're going to say, this volatility, we're really going to move towards stocks that have the ability to raise rates. And we're going to hit things like technology companies that's, we don't think their growth prospects great. So that kind of in-between scenario is a risk for the Fed. The final scenario is stagflation. This is the Fed kind of, makes multiple policy errors, kind of keep rates way too low, right? If they kind of go to 2% and then they would think we're fine, and maybe they're buying assets and just kind of making policy mistakes like they did in the 70s. There's also likely more interventionist actions in this scenario by the U.S. government, where the government could say, we're going to do price controls. We're going to make sure people have to get paid at least $18 an hour. Now it's 20. Now it's 25. Right? If there's this kind of interventionist, heavy-handed, it's going to be the worst possible scenario. Interest rates would likely, on their own, soar into the double digits. This would be kind of a retread of the 70s. Equity and bond prices would go down notably. This would be a pretty bad, difficult time. So which one of these is likely to occur? I'm not sure. Can the Fed engineer a soft landing? It's possible. I think the Fed kind of needs a help, like divine intervention, that the war in Ukraine ends, and then kind of the supply chain kind of works out on its own. And then I think kind of the universe kind of gives the Fed an easier scenario to deal with on their own. I don't know if they could do this. A recession, it seems like, is being priced in more aggressively. The prolonged higher inflation and stagflation, we have to wait and see. I believe the Fed has learned lessons from the 70s, so I think this is less likely, but a possibility. So when we think about how has the stock market been reacting, you can see, I've labeled these. I know there's a number of squiggly lines here, but when we look at this kind of middle section here, both bonds and stocks are down year to date. And this is very notable. For the last 40 years, as stocks have gone up, bonds have kind of gone up, but not as much. But notably, when stocks have gone down, bonds have gone up as a safe haven. But because bonds are so highly elevated, and that's bonds and their yields move in inverse prices. So as the bond prices have gone up, yields on bonds have gone down quite a lot. So there's really no further that bonds can go down. The prices are so high. As interest rates go up, if you have a bond that's paying 3% and interest rates move to 5%, well, the bond that you're owning at 3% doesn't look so hot. So you're going to sell it off as a market. And that's a simplified way to look at it. But what's really interesting is one of the first times in a long time that both parts of a standard portfolio, stocks and bonds, are down. And I think this is one reason that's getting people's a lot of attention. And you can see, kind of the purple line here is the S&P 500, the yellow is international stocks, that, stocks were kind of down into March. And we had this nice surge up till the end of March. And I think that was the market kind of saying, hey, maybe the war in Ukraine is coming to an end. And I think it also was probably saying, hey, maybe I'm looking at the economic data, maybe the Federal Reserve doesn't have to raise rates as aggressively. And then you can kind of see that we've kind of gone up and then we've kind of gone down. And I think the markets are kind of going from, I think it's soft landing, maybe towards that recession scenario. You can also see that really speculative assets like crypto is down quite a lot. And it's not a surprise. Every kind of market increase has kind of speculative assets. Think about tech stocks in 99. Think about real estate stocks and real estate in general, 2006 and 7. And kind of pick your kind of meme stock lately, but cryptocurrencies are down quite a lot. It doesn't mean that crypto isn't an interesting thing to look at. It just means if you pull money out of the system and people are experiencing losses, they'll usually move away from the most speculative, kind of meme stock style investment. And that's certainly cryptocurrencies now. So those are the 4 scenarios. I think the market may be kind of wondering about the recession scenario here. But let's take a look historically. As investors, we at Summit Hill are long-term investors, meaning we're wanting to build wealth over multiple years. We do not market time. We don't try and get in and out of the stock market. But these markets, make anyone concerned. So let's take a look historically at what's happened. And so what's happened is, there's, kind of a trend in the stock market that about 75% of the time the market's gone up on an annual basis. And you can see this kind of skews towards double-digit returns. There's actually not as much times the market's up single digits. It's really up more double digits. So in general, the stock market kind of trends towards kind of good returns, and usually better than 10% returns. And then, there's a number of times where the market is down kind of single to double digits. And it's actually quite rare that the market is down double digits, but these are the markets that everyone remembers. Kind of the crash in 87 and tech crash in 2008 and COVID crash, everyone kind of remembers that. But actually, when you think about it, historically, if you were just to kind of place your odds on in a given year, if the market's going to go up or down, it's likely going to go up. So, that's kind of, for long-term investors, is kind of what you bet on, that companies are incentivized to make profits. They go through difficult periods, they cut expenses, they maintain their profitability, they kind of get through it. Let me just pause. It looks like we do have a question. Yep. So Jason, just mentioned that one of the federal governors say that rates need to reach at least 3.5%. Absolutely, that is true. There are a number of kind of commentators out there saying that short-term rates need to raise, more than they've been, and they've been kind of cagey about that. The people on the sidelines, are kind of saying rates need to go to 5 to 7. It's hard to know. And it's hard to know how inflation will respond to rising interest rates. And I think this is what the Fed's trying to wrestle with. Do you go slow and hope it turns out okay? Or do you like fire a bazooka and, just raise rates, 1% or 2% and just, likely, freak everybody out, but will that take care of inflation? Hard to know. The distribution of stock returns here historically, it's helpful to look at. And then also when we think about these rising rate environments and recessions, how has stocks responded? So many of you are probably familiar with this data, but if you started with $1 in 1970, and now 1970 was a pretty difficult decade to navigate, you can see you were below your dollar, about 75. But from then on, through major multiple crises, whether that's wars, recessions, terrible things happening, like terrorist attacks, for example, the subprime crisis, the market has gone through. And so I think the takeaway for long-term investors is that we go through these periods of economic shock, inflation, rising interest rates, and market corrections, and the market hits new highs. And so for long-term investors, it's not a panacea to say, I'm just going to stay invested. That's not stupid. It's actually logical, because if you believe that it's incredibly difficult, I think almost impossible, to time the market and figure out, should we go in on Monday and back on Friday? If you agree with that premise, and I do, I don't have knowledge of the future. I have an idea of where things are vulnerable. But if you agree with that, then history would say, decide how much risk you want to take ahead of time. You will endure these difficult markets, and then you will reach new highs. And it's and each one of these, I can guarantee you, I mean, I've been investing for 16 years. I can tell you in 2008 people said, Eric, I'm glad to look at this chart. I'm glad that you're telling me things are going to be okay, but this is, what's the word, different. This is not going to work. This is we're gonna lose the dollar. We're gonna go back to the Stone Age, and that's what everyone was saying in 2008. And every time this happens, investors are likely going to say, "This is different." I know what happened before. It's not going to happen now. So I don't think it probably is different. It kind of rhymes, but it's scary to go through. Now, here's the sobering statistic that I've experienced. If you were to go through the S&P 500 from 1990 to what is this, 2020. Take $10,000, you double your money over that time period. If you just invested in the S&P 500, didn't make a move. But what's really amazing is if you somehow miss just the best day, you would impair your return by thousands of dollars. And you can see the returns go from 10.2 to 9.8. And you can see how if you just miss a few of the best days in the S&P 500, you are getting significantly less money at the end of the day. And honestly, investing is about growing your money. So the problem is that usually the best days in the stock market follow immediately after the worst days. And we've seen this just this week. We've seen some terrible days on the stock market this week. Today might be one of them. But yesterday, the stock market had a huge kind of relief rally up. And so the problem is if you kind of say, hey, I think I'm going to go to cash, it's very likely you're going to miss one or more of these best days, and your returns are going to be significantly lower. I saw this after 2008. People patted themselves on the back. Going into 2008, they went to cash. And then the problem was they never knew when to go back out. And the same thing in 2012 when the Eurozone was going to break up. 2018, there was market volatility. COVID, if you stayed in cash, really past, September, you missed some notable up days. So this is kind of the cautionary tale to kind of say, boy, you do not want to miss these dates, because just a handful of dates, you think about just 5 days over a 30-year period could permanently reduce your return from $20,000 to basically $13,000, and your return by multiple digits. So it's cautionary tale to why market timing is, I think, impossible to do correctly. Here's another way to look at it. If you had a 60% stock and 40% bond portfolio, how did that portfolio respond after these very serious events? So you can think about market crashes, savings and loan crashes, kind of economic collapses like 2008. If you kind of get through these periods, portfolios are up, and not by a small amount. after, kind of 1, 3, and 5 years. So I was recently talking with a client and they said, well, yeah, but you weren't necessarily even. And that's true. Sometimes it does take a while to get back to even. But the point is that a diversified portfolio is resilient. And if you go back to that stock that showed how, stocks have kind of handled things, if you're a long-term investor, your portfolio should be diversified. And that's, I think, the kind of key thing that I would focus on. We think that there are things that matter and things that you can control. And it's the intersection of those two that really matter for investing. First, create an investment plan that fits your needs and your risk tolerance. If you're 100% stocks and that's not your risk tolerance, then it's good to make an adjustment. Structure the portfolio to pay attention that there are certain types of investments that have done better than the broader indices over time. Think about value stocks, small cap stocks, more profitable companies. Those investments have done better than the broader market over time. And you can think about that. Diversify globally, avoid the tendency to kind of say, I only want to stay in my home country. Certainly manage expenses, turnover, and taxes. Those matter quite a lot. And then stay disciplined. Avoid the temptation to go to cash and miss those updates and permanently reduce your future returns. So there's, that's more than enough for investors to kind of control. We don't have to control the stock market. We don't have to control the Fed. We can control these things and get the outcomes that we're looking for. So what can investors do? This is some points I went over in March. I think they still apply. Prepare a financial plan. If you are kind of just sitting on cash or in an investment portfolio and it's not tied to your own life, then it's just kind of, you're watching it go up and down and there's kind of no context. If you create a financial plan, there's a purpose to the money. It's to grow for a charitable donation. It's for your own retirement. It's for college savings. It's for a purpose. And when you understand, here's the purpose of this investment or this part of the portfolio, then you can look and say, can I handle the volatility? Can I handle the downside? And often I find by kind of being really clear about the purpose of a part of a portfolio or an allocation gets people to the point where they say, yeah, I can handle that. So ensure your risk tolerance are in sync, focus on the long term, and then we'll talk about some rethinks. So this is an example of how we create a financial plan for clients. We look at where they are right now. We look at their expenses and income over time. And then we want to know, out of 1,000 different iterations, it's called a Monte Carlo simulation, how many of these are positive? And if we're looking at 1,000 different iterations, some of those are very optimistic, but many of those are very negative in terms of assumptions. And you can see that kind of dispersion, what happens to this individual portfolio. Yeah, would it be great to be up towards 8? Sure. But, here we're down at 5. And that means in 100% of these scenarios, they're okay. They can achieve their purpose. And I think that is what I always like to go back to with clients, which is we're investing for your goals. We're not simply investing to try to beat the stock market. We're not investing to try to be on the cover of hedge fund stars, right? So when we have that long-term context and when we test and stress test your financial plan, then we could look at these downturns and say, well, the analysis included these downturns in the projection. So we've already kind of looked into the future and saw what would happen if the stock market did badly repeatedly. Am I and my family okay? And if we know you're okay, then you go, well, then you can make it through. It's okay. So that's, I think, what I love to start with a client and I love to go back to. The other thing is make sure that we are kind of in sync with, our goals. So if you have, a goal to grow assets, these type assets will be, kind of potentially a potential higher part of your portfolio, larger part of your portfolio. And we will just know that, yes, there's higher risk and volatility in order for us to get the higher projected returns. And then if we think about assets that we'll need over the next 8 to 12 years or assets for the next 1 to 2 years, we go down and we get more conservative. And for many of our clients, this is a diversified portfolio that includes some safe assets and also includes some growth assets. And the ratio determines how much your portfolio will move. But I'll tell you, one of the things that I really encourage clients not to do is not to look at the dollar value of their portfolio, because what's that doing is it's taking all of these assets that have different purposes, it's just mashing it together and say, yesterday I had 2 and today I have 1.99 and now I feel terrible. But if we understand that, if we look kind of past that dollar value at the bottom and we say, well, these assets, these stocks are designed to grow over kind of 10 to 15 years. These bonds are designed to be more stable. then we start to kind of look past just the headline number and start to say, okay, and how do we feel it? So if you're a client of Summit Wealth Management, we've had this discussion. If you feel like, this market is exposing some parts of your portfolio you don't necessarily feel comfortable about, let us know. We're happy to reevaluate it. But I always want to say, look past the headline number, look at the components. There's some really common mental errors that humans make when they're investing, and these are called behavioral biases. A number of people have won Nobel Prizes kind of identifying this, but these are kind of the three that I notice most affect investors. The first is projecting recent returns forward. And this is in a year like 2021, people say, 2022 is going to be awesome. If I made 20% last year, I think we're going to make 25% next year. No, that's not the way it works. And it also doesn't work that just because assets are negative year to date, it doesn't mean that we're going from negative 15 to negative 50. People tend to just kind of play the recent tape forward. It's a mistake. It leads to cognitive kind of errors and investing mistakes, because they'll kind of project forward and say, well, if we're down year to date, I'm sure we're going to be down double this in 6 months. Not necessarily. And people also kind of fall in love and hate assets. If you were involved in crypto in kind of 2018, 2019, 2020, you probably loved it. And now maybe you're thinking about selling. Maybe you love stocks, and particularly technology stocks in 2020 and 2021. Now you can't get out of them quick enough. That kind of love, hate, good, bad, black, white viewing of portfolios, I don't think is very helpful. I think you basically just say the market goes through periods where it's really, really hot on one asset, for example, gold, year to date, but it doesn't mean that it's always going to feel that way. And a diversified portfolio usually should have parts of the portfolio that are underperforming. The last thing I'll say is that I had a mentor of mine say that sometimes investors like to play checkers when the market plays chess. And what I mean is sometimes investors make really simplistic analyses of the market, and it's just not intellectually rigorous to say something like, well, if inflation is higher, then everyone is going to pull back their spending and the market will crash. It's too simplistic. That's not exactly how it works. As employers increase their prices, they continue to pay employees. Those employees still make purchases, for example. So avoid kind of overly simplistic rationales. Newspaper articles are terrible at this. They tend to say the market is down because Netflix subscribers are down. That's like, well, there's a lot of things that go into why markets move on a given basis. So just be cautious about kind of overly simplistic kind of explanations of what's going on. Finally, in terms of asset allocations, while I do believe we are long-term investors, I think it is prudent to look at trends and think about what part of the portfolios may be vulnerable and where there may be opportunities. So in stocks, it's a good time to rebalance. In general, stocks have been an excellent inflation hedge because companies can raise prices. In fact, many of the markers of CPI, meaning what's measured, is prices of companies. And so if CPI is going up, that means gas stations are raising prices. It means Johnson & Johnson is charging more for their toothpaste. So let's own gas stations in Johnson & Johnson, right? And that's the data we see in rising interest rate environments, and even in, kind of low to moderate inflation periods. Stocks actually do okay. It doesn't mean they don't have periods like this where they dip down, but stocks actually do all right. One thing I am changing is earlier in the year, I thought there was an opportunity in international stocks. I think the war in Ukraine continues to drag on. And if we are looking at a higher risk of inflation, it could be a good time to kind of reduce allocations to international stocks. In general, US stocks do better in a recession. So one thing I'm doing is kind of pulling back international and moving towards US. I know I said avoid home country bias. It's not as if we're eliminating all of our international stock exposure, but on a relative basis, we're pulling back. For bonds, we're shortening our average maturity. It's very possible that interest rates may go to that 3.5% that Jason mentioned. It could go up to 5%. Bonds go down as interest rates go up. And so, I think it makes sense to kind of reduce your average maturity because that reduces the exposure to interest rates. We try to use managers that have a good track record of handling volatility interest rates. I am also reducing allocations to international bonds because as US interest rates go up, it makes the US dollar more attractive, and that usually puts pressure on international assets, both stocks and bonds. And then for many of our clients, we do use bond ladders. It's a great way to kind of smooth out volatility in the bond portfolio. So that's a great way to do it. And then I've talked in the past about the diversifiers we are using. We have a good allocation to real estate. We love managed futures. Managed futures, if you don't know, are a trend following strategy that follows the trend up or down. And so managed futures have been doing very well, not only last year kind of straight up, but also kind of this year kind of straight down. I've been adding exposure to commodities in case inflation kind of continues to roll forward and the Fed doesn't use it. We also, for certain clients, do recommend private equity and hedge funds just as another way to get exposure. Private equity is intended to get kind of a higher return on stocks, and in exchange you have to kind of give up control over the asset for multiple years. Hedge funds kind of are accessing lots of different asset classes, usually in a trading strategy, and their intention is to try to get good positive returns but not have as much downside. So these are the changes that I consider important that we're implementing for clients, but I'd caution people to avoid swinging too far one way or the other. For example, we're making changes to portfolios, but we're not selling out of bonds. We're reallocating stocks, but we're not getting out of stocks. We're adding to diversifiers, but we're not making them 75% of the portfolio. So, I just encourage people to be careful making those kind of big swings in portfolio, because the penalty, if you're wrong, can be notable. For example, if the war in Ukraine were to resolve, if inflation were to moderate in June and July, and the Federal Reserve would say, hey, we're going to raise rates pretty slowly, you would see likely a notable move up in stock prices. I would guess somewhere between like 8 and 12%. I mean, you would just see the stock market go, whoo, things are great. And if you had gotten unusually defensive in your portfolio, the market just kind of moved notably away from you. And then it's hard to invest after the stock market has gone up quite a lot. So I just encourage people to be thoughtful. If you're a client of Summit Hill Wealth Management and you want to chat about any of this, we would love to talk to you. We are reaching out to clients right now just to touch base about volatile markets, set up times to chat. It's kind of normal time when we would think about second quarter meetings anyway. So love to chat. If you're not a client of Summit Hill and you'd like a second opinion, we would love to talk to you and just give you kind of a free observation on your portfolio and expand on this. So thank you for your time. And I'm just going to pause and see if anyone has any questions. You can type them in the chat. You can type them in the Q&A. I'd love to answer any questions anyone may have. Okay. Not seeing anybody kind of speak up. So if you have a question, if you wanted to follow up, I know some people will say, I don't want to ask my question in front of everybody. Call or email me. You can see our general email here and reach out. But we appreciate your time. If you're a client of Summit Hill Wealth Management, thank you. We know volatile markets are not fun to go through, but I think discipline kind of saves the day. It's always kind of saved the day for good and bad markets. Thank you very much. Have a great day.